All right, so it's 11:59. I'm just going to welcome everyone who is hopping in. Tiffany, I'm checking the chat now. Some music, yes. We'll have to get on that. Okay, so for those of you, I know you've got Tanya's lovely photo up there, but it's Leanne today, as Tanya is double booked again. So I'm filling in for her, but I think Twyla's going to do most of the work and teach us all about Helm today. So what I'll do is I'll take us through just our kind of little introduction, and then I will let Twyla take it away. So there we go. So welcome to, pause that just a minute. It is jumping through my slides on me. There we go. Welcome to our financial advisory webinar series. Obviously, today Tanya's not hosting you. You've got me instead. For anyone who doesn't know me, I'm the operations leader here at Cloud Bookkeeping Services and Tanya's Bookkeepers Bootcamp. A little bit about Tanya. Most recently, she was awarded the 2019 Professional Leader of the Year from IPBC. And of course, our other qualifications there are pretty typical. She's also a new board member on the IPBC, so that's exciting news for us. And then just about the webinar, we have been submitting all of the webinars through for CE credits, but they are they need to be approved, and although we don't expect there to be any issue, we have to do it 1 month at a time. So that's, if you're waiting on some certificates, I think they were a little bit behind last month. So it's coming, but just be patient. Once we have the approval, we do send out the certificates within 2 weeks of receiving the approval. The recording of this webinar will be out within 2 days, and in order to qualify for any CE throughout the webinar, there will be a total of 2 polls. So please make sure that you complete those questions and answer those questions for me so that I can ensure you get your credits. Sorry, I lost my mouse. There it is. And of course, today we are talking to Helm, and very, very exciting to have Twyla with us. So I'm going to stop sharing my screen and let Twyla take it away.
Sure, sounds good. I need to start with an apology about my voice. Since QVC, I haven't really had a voice since coming back the day. It started to come back, and then we were at an event last week and basically yelling the whole time, and it has not really come back entirely. I tried to rest it all weekend and it didn't really work. So my apologies for that. But I want to start with saying thank you to both Tanya and Leanne for having us be a part of this series. I love what you guys are doing. I love that you guys are leading the way in terms of helping other bookkeepers and accountants in this industry with advisory, with just knowing what you're sharing, what you know about your experience and what you've learned in terms of bookkeeping and working with clients. So thank you for letting us be a part of that.
Well, thank you.
And I wanted to just say that at the end, I will make sure that I've allotted some time for Q&A. So even if we're starting to run low on time, I'm going to cut the demo portion short to make sure that we have that time. So feel free to shoot me some questions in the chat, and we can get to those at the end.
Perfect. And you guys can all put those into the question and answer part. And what I'll do is, as I see them come in, I'll mark them. If it's something really, really relevant, I might try to pop in and interrupt Twyla, but unless it's really, really relevant to what she's saying, I'll leave those till the end and mark them as something we'll answer at the end.
Yeah, that sounds great. And if you don't mind watching that chat, and feel free to interrupt me. Just don't hesitate to do that, and I'm happy to answer questions along the way if it makes sense to do so.
Perfect, thank you.
Okay, perfect. So let me just share this over. Okay, can you guys see my screen? Can you see the screen?
Yes, we can see the screen.
Perfect, thanks, Dan. All right, so let's go ahead and get started with, oh no, I'm not, there we go. Go back, here it is. I'm going to do some introductions, and I appreciate I took a quick look at who's on this call, and I know that some of you know me and probably know me quite well, but I'm going to start at the beginning anyways, just to give some introductions for those of you who maybe don't know me or don't know Helm. So firstly, a bit about myself. I'm a CPA. I'm here in Calgary. I have not had a traditional accounting career. My career has kind of meandered quite a bit from traditional accounting. It did find its way back to accounting about 5.5 years ago, but in the interim, I was doing some more entrepreneurial type roles and really taking on some of my own business ventures. I honestly became an accountant as my backup plan. It was never my plan A. I knew that it would be the, in case I needed it. I thought the world would always need accountants. Now, I could say that's probably not necessarily true now that I see where the industry has gone, but I'm not your traditional accountant, and I'm not afraid to kind of admit that I've got colleagues who've got far more experience in accounting than I have, but my experience is very varied, which kind of puts me into a different spot in terms of operational accountants and a entrepreneurial mindset. About 5.5 years ago, Calvin and I, my business partner, we started 2080 Financial Services. And, you know, we've always been in that advisory space, and I'd love to take credit for thinking that we were ahead of the curve and knowing that, you know, the entire industry was going to make this shift in the past 5.5 years. I can't say that that's entirely true, though. That's not why we got into the advisory space. We got into the advisory space because, as I spoke about, I'm not a traditional accountant. Do not have a tax background. I do not have an audit background. I've always been in these other kind of different roles, and so is Kelvin. To be honest, he actually comes from a background of being a CFA, and then has spent his career in accounting. And so because of that, we wanted to do something that was a little bit different, something that spoke to our skill set, our area of expertise, our opportunity to give back to small business clients in a way that wasn't traditional, was something different than what they would get if they went to, you know, a larger accounting firm down the street, really filling the gap for small businesses between, you know, maybe they were doing it themselves or had a traditional bookkeeper on staff and then had a year-end accountant. So we wanted to give them more of a consultant feel, an outsourced CFO or controller feel, really somebody that partnered with them in their business and worked with them on at least a monthly basis and in some cases a weekly basis. About a year, not even a year into our journey, we became 100% cloud-based. We really took on technology in full force. We challenged ourselves to see what could we make the automations do, what could we make the workflow do for us in terms of efficiencies. And the more efficiencies that we gained with the traditional bookkeeping and accounting tasks, the more time we could spend in the value-added tasks. So again, this isn't something that was really spoke about. The word advisory wasn't as much of a buzzword then as it is now. It just happened to be where we took our practice. And lucky for us, it kind of has worked out that that's where a lot of people now are taking their practice or have already taken their practice. So it's been really fun to be part of that parallel in terms of what the accounting industry has done and how the traditional roles have really shifted. So because we took more of an advisory standpoint from day one and we're more operational accountants, a big component of our services back to the client was cash flow forecasting and cash management. So we spent a lot of time in that area of doing those tasks, truthfully using Excel as our cash flow forecasting tool, which you know, that worked, but it wasn't necessarily the right tool. But we wanted to keep doing this service for our clients because at the end of the day, the clients were not necessarily coming to us saying, I want you to create a cash flow forecast. They were coming to us saying, I can't sleep at night because I'm worried that I won't make payroll, or I'm concerned that I won't pay myself and I won't be able to feed my family or pay my mortgage, or I want to grow and I don't know if I can afford to do that, or I'm overworked and I need to hire an assistant. Can I afford to do that? So these are the types of questions that would come to us. It was never I would like you to create a cash flow forecast. It never sounds like that. It always sounds like something different. And it's an area of advisory where it's stressful for clients. It's stressful for them to know as they're running their small business, will I have enough money? So a big part of our advisory services has always been cash management and cash flow forecasting. So like I said, for the first 4.5 years of us doing cash flow forecasting, we used Excel, but about early 2018, we decided we wanted to create our own app, and that's where Helm was born. So before I go into a little bit more about Helm, I'm just going to start with the first poll question. So Leanne, if you don't mind helping with that, this is a question that I think you can pop up the box for us.
Okay.
Have the participants.
I will pull up the poll question. I do have a couple people who are having trouble hearing. So if we can, I don't know if there's anything we can do, because I know you're losing your voice and I don't want to strain it too much.
Let's try this. Is that better?
I think that's much better. So for those of you who are having trouble, if you want to just throw me a comment. Jessica says much better. Thank you. 100% better from Dominique. Okay, fantastic.
That was what I call an ID10T error, which if you spell out ID10T, it means idiot. That was me. I had the wrong thing clicked off for my microphone, so my apologies, people.
Oh no, okay. So I'm going to launch the poll though and give you guys all a chance to hop on there and answer this question. So the question is, are you currently doing cash flow services for your clients? And we've got yes, no, or sort of. We've got a bunch of different answers coming in, kind of a good variety of people. We are looking for everyone to answer this in order to, if you want to qualify for your CE credits, I do need you to answer it. So we're getting there. I'm looking for 3 more people to put their 2 cents in. I'm going to give you about 10 more seconds, and then I'm going to close this off. So we're at 5, 4, 3, 2, 1. Okay, I'm going to end that. And I'll share those results for you, Twyla.
Thank you.
There you are.
Perfect. And it's always funny. I love putting in the words "sort of" as an answer to one of these questions or to this question. And it's funny. I mean, that's the predominant answer here, which is always interesting to me to find out that people are feeling like they sort of do it, because that's a chance to dive in and dig deeper and see why is it they feel like they're sort of doing it, and what can we do to help make them feel like they are doing it. So
awesome.
Perfect.
Okay, let me get that out of your way.
Great. So I've shared a little bit about this already in terms of why cash flow and why I'm obsessed with cash flow. And really, obviously I'm a bit biased now that we've got Helm in terms of why I'm obsessed with cash flow. And it becomes a lot of the conversations that I have day in and day out. But, we all are feeling this pressure in the industry to change and to evolve. And I've never taken this pressure as something that's a threat, we're all going to lose our jobs or we're going to become extinct. I don't necessarily feel that, although I kind of joked about it at the beginning. I don't feel it that way. I feel like it's more an opportunity to just do that, evolve, not to make us scared, but rather to change. And I am, for one, even though, I have the traits of a traditional accountant, I like to be set in my ways and do things the way I like to do them. At the end of the day, it can be a little bit boring and mundane. And so this is the opportunity for us in the accounting profession to evolve, to change, and to give more value back to the clients. So, when I say that, I mean, there's value obviously in traditional accounting and bookkeeping, but the clients don't actually value that. They see that as a necessary evil from my experience. And so when you can have conversations with them that go deeper than doing the day-to-day and doing the more mundane tasks, then that creates the opportunity for a deeper relationship. So, because of the fact that we have always done cash flow as a big component to our services, the reality is when I looked back on why we did that, I realized that every client conversation that I have outside of a conversation saying, hey, where's your backup? Or what's the hours for payroll this week? Every other conversation is essentially starting or ending with cash. So whether that's the, I don't feel like I'm going to have enough cash conversation with a client where they're stressed, or it's a conversation of, I always like to call these clients the overambitious clients where they're like, I'm going to grow and I'm going to add this and I'm going to buy that. And, even those ones, you got to say, pump the brakes. Let's make sure that you can afford it. And so that's really why everything for us comes back to cash flow, and why we're so obsessed with cash flow is because when we talk about advisory, you can really say that all those conversations, no matter kind of where they start or stop, there's something in there that loops you back to, do I have enough money? How much money will it be? Or something related to cash. So as a result, in our organization here, so when I speak on behalf of Calvin and even the rest of the team, we've now become obsessed with sharing all that we know about cash flow. But I want to say this, I do know, and I am not so egotistical to think that there is not more than one way to firstly scratch the surface of advisory, and secondly, to do cash flow forecasting. There's a variety of apps in place, there's a variety of methods to use. All that we are doing is trying to share all that we know about cash flow from our experience before starting 2080, from our experience within 2080, and then now with our experience of Helm. And so that's what we're trying to do on a day-to-day basis. That is our primary goal, is that we are obsessed with sharing all that we know about cash flow. So where do we start? This is often the question that we get asked, is where do I start with cash flow? And to me, the answer to any good question is it depends. It depends on what type of cash flow you want to create. As I mentioned, there's a variety of apps in the market. There's a variety of needs that your clients would have, different industries. Are they flush with cash or are they super tight with cash? So determining the type of cash flow forecast that you would like to create can be a great starting point as to then determine where you should start. And I won't go into the different types of cash flow forecasts, but there's a variety of different types. And even you can talk about, do you need super granular versus do you need high level? And so that can even be the spot of where you start. But I will also say this, that Excel can be a very good place to start. We used Excel for 4.5 years. In fact, we are rolling out a Helm cash flow certification in 2020, and that is going to be starting with Excel. I believe that Excel is an amazing place to start if you've never done cash flow. Maybe all you've ever done is just the traditional cash flow statement. The type of cash flow that I'm talking about when we're talking about a forecast is not that statement. It's different than that. And when you work through it in a very manual and labor-intensive fashion, you really get to know the ins and outs, what's going to happen and why within a particular client's forecast. And so I do believe that Excel is a great place to start, but obviously I don't believe it's a great place to stay if you want to scale your cash flow services, because it's labor intensive, it's error prone, it becomes outdated the next, as soon as another transaction rolls through the bank. So I don't suggest that that's a place where you hang out, because you're going to find that it's just not conducive to rolling out that sort of service to all of your clients or to a number of your clients, but certainly a place to start. And then once you start with that, you'll get a better idea of, okay, what is it I want to provide for my clients as a service in the realm of cash flow? And that will help you determine which app is the right app for you. Okay, so to get in a little bit more about Helm, obviously, based off what I've said, I'm sure you can imagine, Helm is designed to do more of that heavy lifting. So a big part of when you're creating a cash flow forecast, whether it's in an app or in Excel, can sometimes be the heavy lifting that's required to set up the forecast and then to maintain the forecast. And so Helm is really designed to do more of that heavy lifting when it comes to the initial setup and then when it comes to the ongoing maintenance. It's also designed to be very visual for your clients. And so this might seem really obvious, but I'll tell you a little story. I was working with a client, and for 2.5 years, I was creating their cash flow forecast. And this is a client that still had a checkbook. Now, I did not want her to be writing checks, but she would write checks, much to my dismay. And so I would go through the cash flow forecast with her. They were very tight on funds. I would go through that forecast with her, and I would show her, you know, you're not looking good. and there would be some times when it would actually dip into a negative circumstance. And I would tell her at the end of it, I would first say, do you understand? Yeah. Okay. Please don't issue any payments. And here's why. As you can see, if we do pay all the vendors right now, you're going to be in a negative situation with your bank. And they did not have a line of credit. And time again, she would still issue a payment. And believe me, this was super frustrating. And I felt like I was being a mom to her. I'd go back and say, don't you remember that conversation we had? Obviously, I would be nicer about it than that, but that's what I felt like saying. As it turned out, after 2.5 years of doing this cash flow forecast for her in Excel, she said to me, I don't understand what it means when a number has brackets around it. And this, I was so shocked. I had no clue that somebody would not understand that. Now, to her credit, she's very visual. She's not an accountant or bookkeeper, obviously. She's very much a creative type. And I had no clue that she didn't actually understand what that meant, even though we had said, you know, are you following along? And she would always say yes. So that quickly explained why she kept issuing payments, even though the fact that, you know, it showed brackets, meaning negative, into the, you know, negative in their bank account in the future. And so if we had at that time had something that was visual and a graph for her, she would have definitely got it. Then it's also designed to provide insights into the cash future. So for me, as somebody's advisor or their consultant or their partner in their business, when I see that the cash is either going up or going down, first thing I want to know is why. Why is it going up or down? I mean, if it's this gentle trend, it's obvious. If it's a gentle trend down, still obvious. But if it all of a sudden kind of spikes up or spikes down, first thing I need to know, why did it do that? And that's going to be the question that the client's going to ask is, why is it doing that? And then secondly, probably the most important question in terms of, you know, what Helm is designed to do is say, what the heck are you going to do about it? Because that's ultimately what the client has hired you to do, is not just forecast it. You don't just hand over the forecast and say, here you go, looks like you're going to run out of money in a month. Good luck. You want to say, you potentially are going to run out of money in a month. Here's some options that we have. Let's look at what we can do to action off of this to make sure that that doesn't happen, or to alleviate that from happening. Or maybe you need to even do some short-term, like pulling some things together that's not going to be comfortable, but then what's the actions you're going to take in the future to see that they don't end up here again. So from here, let's dive in and I'll show you a little bit more about what Helm looks like. So excuse me while I just flip my screens here. Okay, I'm going to assume that everyone can see the screen that's showing the Helm app on it now. So if not, please feel free. I'll watch the chat this time and not ignore you guys.
We see
you
the
got
right
it?
screen.
Okay, perfect. Okay, so when you initially connect Helm to QBO or to Xero, this is what it's going to look like. And so before I walk through these graphs, I'm going to take you through what we call the drawers at the side here. So first drawer, this is your actual bank accounts and credit cards accounts pulling in from QBO. And so you'll see here that this is the balances. It would be reflected in QBO. you have the opportunity to toggle these on or off, and that's going to affect the opening balance of your cash flow forecast. Because obviously when you're creating a cash flow forecast, you're starting at today and moving forward. So what do they have in their accounts today, and what's going to come in, and what's going to go out? And so this is important to us because different people do their cash flow very differently. Even within our own firm, Calvin and I do our cash flow forecast slightly differently, in that he likes to include the credit card right from day one. So meaning that the opening bank balance in this case is going to be the net of all of these accounts, versus I like to account for a credit card payment later when the payment is due. So that's a simple option, is you just toggle it on or off. And once you set that up, it's not that you can't go back and change it. You can change this on and off as often as you wish. So then what it's going to do is pull the existing accounts receivable from QBO. So it's going to put in every invoice you've got outstanding, grouped by the customer. And then when you expand here, you can see each individual invoice. Now I apologize, before we jumped on this call, I realized I had pulled in an old data set, but nonetheless, it's still gonna work. When you open these up, you can expand, see every invoice that's sitting as outstanding accounts receivable. Now, one thing to highlight here is we do not forecast based off of term. We actually ignore term in the system altogether. And that's strategic. That's because often we find people do not pay on term. So even though terms are 30 days, doesn't mean that customer pays in 30 days. And so we're trying to keep everything, firstly, more realistic, and secondly, all within Helm. So if, for example, in this case, you can see Burns Industries, they obviously typically pay in 15 days. Now, if they are not going to pay in 15 days, you can overwrite that. You can change it higher or lower, depending on what you think. If their payment habits have changed, you can change it for the entire customer set. I mean, all invoices that customer has outstanding, or invoice by invoice. You can also toggle on and off, again, by customer or by invoice. So this is for if you've got something outstanding on your accounts receivable that's likely not collectible, or it's really unsure, you could just simply toggle it off. It'll stay there until such time that it clears off of your AR within QBO. And then it's sitting there grayed out like you see here. And then if you realize, oh, this actually is going to be collectible, then you can flip it back on. So it's good for things like doubtful accounts, where you think that there's maybe some bad accounts on file that you haven't cleared out of the books yet. AP looks very similar. So same idea, it's going to pull in what we call average days payable versus average days receivable. Again, going vendor by vendor in this case. How fast have you paid that vendor in the past? Ignoring the term within QBO, simply going off of the historical. Because when we pull in the data from QBO, it's going to look back through 3 years of history. Now, if you don't have 3 years of history, because I get asked this question a lot, that's fine. It just means that it's going to be less concise. And as you have more and more data in the system, especially somebody brand new, maybe you only got a month or two of data, the further along you get, the more data you create within QBO, the more precise this is going to be. But it will pick up that data and that historical information to determine how fast you've paid in the past. So that's the easy starting point. Now the heavy lifting. So when it's scanning through that data, what it's looking for is consistency, repeating information. So great examples of this are things like rent every month, payroll every 2 weeks, truck payment on the 15th of each month, things that you see very consistently rolling through the accounts. So if we look at rent expense here as an example, in this case, we've been able to see that, again, I apologize, this is an old data set, but that at the end of each month, or depending on timing, if you're paying the end of each month or the beginning of the following month, every 30, it's saying this long random number because we don't always have 30 days in every month. Every 30 days, there is $10,000 in rent coming out of the account. Another great example, let's see, in this data set could be something like salary expense. So in this case, this guy is paid every 14 days, $6,500. So it's going to look for that information to be able to build that out for you. Now, if that's changed, so for example, with rent, if you know that they've rented an additional space or their rent went up in the last month or so, then obviously it's here for you to override entirely. Maybe it's gone up to $12,000 and you could save that. Maybe, the data's changed. They used to pay at the end of each month and now they're going to pay on the first of each month. You can change that here with the calendar. You can delete this entirely if Helm's picked up something that's historical that is no longer. So maybe it's picked up rent recurring every month, but just last week or last month, they bought a building. They'll never have a rent expense again. Now they're going to have a mortgage expense, a mortgage payment. And I'll show you how to set that up in a moment when it's something entirely new. But you can delete here. You can also toggle on and off if you're wanting to say, don't include this for the short term, but leave it there. I want to be able to change it later. You can do that as well. So everything is intended to be manipulated or adjusted based on what you know for client intel. But again, doing more of that heavy lifting. So anything repeating, recurring, it'll pick that up right down to the vendor and even the customer level. It'll do it with revenue too. So take, for example, your accounting and bookkeeping practice. If you've got some clients who are on monthly flat fee billing, it's going to pick that up if there's a history of a couple of months of that happening. So it would pick that up right at this level where you're seeing here. So obviously Acme Corporation every 30 days is being billed through $862.75. So again, it's there to change. If you know the billing has changed, maybe you've lost that client in the last month, whatever, you can change it, but it picks that up. Then what it does is when there's things that aren't as consistent, so great examples of this are meals and entertainment, office expenses, repairs and maintenance. So things where they're sporadic all over the month, different amounts, different vendors. What it does is it pulls in a monthly average. So when I created a cash flow forecast within Excel, the biggest thing for me was firstly, obviously scouring the previous data to see what's that repeating consistent information. But then I would get all of that in there fairly consistently and easily because you've got that history. But then I would look at it and say, okay, what the heck else do they spend their money on? And so that's what this is intended to capture is what the heck else do they spend money on? And so again, this is picking up an estimate. And what this estimate is right now, this is on the roadmap to change, but what it is right now is this is a monthly average. So this is a 12-month average. So in the past, obviously, these guys have spent $300 a month on repairs and maintenance. Again, they're free to change if you're like, I know that they've got some big repair bills coming up, that needs to change entirely. Or maybe it's the reverse, maybe it was high and now it's come down. Or maybe that was something that, again, was consistent in the past, but is no longer the case. So you could, at that point, take it off entirely just by toggling it, which would leave it there for future if you wanted to be able to add it back in. Or you could hit delete and then that's going to clear out entirely. So this is going GL account by GL account. At this point, it's only picking up your P&L, which I will show you how to add balance sheet items, which would be a great example with a mortgage payment, where obviously a portion is principal, a portion is going to interest. I'll show you that in just a moment, but that's kind of the basic framework that you'll see when you first connect Helm. And from there, let's walk through these two graphs. So the first graph is the obvious graph. That's your cash balance. So you can see that it is creeping along here. And as you highlight over these data points, you can see the actual balance. So on November 23rd, for example, we're predicting it's going to have 34,000. I'll get to this point in just a moment. So on the bottom, everything that you see in the bottom has actually come from these drawers. So everything above the zero line is coming in. Everything below the zero line is going out. So again, as you hover over, you can see this detail to find out where did this come from. And in the case where the bar is not solid, it's this hatched bar, that means that it's an estimate, versus something that's in a solid bar is more concise. Whether that means that it's your existing AR, like this one is, you can see it says invoice 0072, so that's accounts receivable, versus something like this. This is one of the items that we picked up. You might remember I showed it in the drawer. We picked it up with some concise information. We saw that Bruce Wayne was consistently paid every 2 weeks. So depending on how concise it is versus this is a really random estimate. I mean, I shouldn't say random estimate. It's an estimate though, and it's there as hatched to highlight that to you, to say this is an estimate. So be mindful that this isn't a for sure. This is what you've estimated and may need to be adjusted. So as you're looking at everything here, everything on this bottom graph is drag and drop. So let's go back up to this top graph. As I said before, when I'm doing a cash flow forecast, the first thing I want to see is there something going to happen here? And as you can see here, they're going to run out of money on December the 9th. And so I can see it's going to go down to negative $7,600. So that's the first thing that I see is it's going to go there. Then what I want to know is, why is it going there? So if you just go right below it, you can see this big expense, vehicle expense, going out of the account on December 9th. So in this case, let's use this scenario where our client has said, I want to buy a new vehicle. I'm hoping to buy it by December the 9th or December the 10th. And we've put it in there to reflect this is going to be coming out on December 10th. But as you can see, clearly not good timing based on what we forecasted. So in this case, when you go over here, you can see, well, it bounces back up again here. And if you go here, it's because we've got some project revenue coming in. And so what you can do is say, okay, the 9th is not a good day to buy it because you don't have enough money. You can drag and drop to, let's say you wait till the 15th. Okay, now it makes sense. Now you can do that. And so that's where, for me, on an ongoing basis, I spend all of my time in this bottom graph. I drag and drop everything. And so the initial setup is all done in these drawers, but I love to be able to look here. How does it look? And then what I do is I look to see what has tolerance, what can wait, or what can maybe be incented to be collected earlier. Because a lot of times with clients, it's not necessarily a cash shortage, it's a cash gap. Clients tend to pay too soon, collect too slow. And so this can really highlight how that timing makes a difference. This is a great example. Nope, you can't, if I put this back, you can't pay for that truck on the 9th. You're going to have to wait till this project revenue comes in. And if this revenue does not come in on the 11th, as is speculated, then you can't even buy it on the 15th. It's going to dictate the timing. These two are very correlated. So let's say the example where, two examples I'm going to do. One example is you're going through this initial setup and you see that, okay, they do have something coming in. This is how I set this vehicle up. They have something coming in that you've learned from conversation with your client. So intel of some sort. So the example of even a mortgage payment. So what you can do is you can go into the forecasting drawer and add something new. Now this particular client probably does not have anything set up for mortgage because I didn't plan on that data set, but let's use, it doesn't really matter truthfully which GL account we use, but all of your chart of accounts are here. So you can still choose a balance sheet account. As you can see, wages payable. Let's just grab, here, we'll do this example. Let's say that we've got some taxes coming out and we're just gonna grab something. This is as simple as it is to add something new. So you would choose your account, GL account, you choose the vendor or the customer, if it's in or out, incoming money or outgoing money. Choose which date you expect it to come. Again, remembering you can drag and drop in the graph, but let's say it's going to be the 30th. Frequency means, will this be ongoing? So is it something new? Mortgage payment, for example, every 30 days. So if you do 30, that means 30 days. 14 means every 2 weeks. 0 means one time only. So let's say it's outgoing money. We're going to pay it right at the 30th, and it's going to be $10,000, for example. So I've added this every 30 days just to give us another example. And now when I look at, oh no, here, sorry. Oh, I shouldn't have put it on the 30th because we've got lots of other things there on the 30th, but that's okay. Here it is here. So the 30th is there. That's the $10,000 I put to bubble gum. And so then that's affected our cash. And so as you can see now, if you'd watch this line, it changes it. And again, if we're like, well, no, it won't actually happen on 30th. It's going to be on the 13th. Same thing. You can still drag and drop. And it changes the graph above. Then the other thing that I'll show you is how to create a scenario. So this is for those clients who say, I want to buy something. What does that look like? I want to hire somebody. Can I afford it? I want to buy a piece of equipment. What's the best timing? So this is what that's for. So always your base case should be planned out as best as you know it. So what do you know from the client and from your information, looking at historical from QBO, as best as you can see what's going to happen. And then your scenarios are those what ifs. So let's call this test just to put something in there. Now, when you create a scenario, it always creates a duplicate of your base case as a starting point. So as you can see, these are mapped exactly the same. If I flip over, it's essentially one line. You can even see these data points turning up in teal. That's showing you it's exactly the same. So you can do a few different things here. This could be where you could show the timing. For example, don't do this yet. Buy this vehicle later in the month. And here's what it looks like. So you can see now the deviation. The deviation here was on my base case. I was saying you're going to buy it on the 9th. In this new case, I was saying you're going to buy it on the 18th. Either way, in this case, now that we've added that extra 10 grand a month, they still can't afford it in the short term. But you can do that as an example. Let's put this back just to make it simple. And so now we've got exactly the same base case and our test scenario. By the way, you could just delete the test scenario and start over instead of having to remember where that was. But if you said, okay, I know they want to hire somebody and they want to see, can I afford to do that? So we'd add salary expense. We'll just grab up a vendor. And let's say it's going to be starting this Friday. They want to hire them. Every 2 weeks, they're going to get paid. Let's call it $3 grand every 2 weeks. So you can hit save and close. Now you can see that difference starts here at the end of the week. And if we go it a little bit further, you're going to see the gaps start to spread. It's a little tricky to tell because they're dipping into the negative, but you can see here the gap's very small and it increases. And if we went out even further, it would increase because we've added another salary every 2 weeks that we weren't adding in the past. So this is a little bit of a weird scenario because I've still got this big expense here for vehicles, but it would show, can I afford to do that? And so what you can do is you can start with layering in things. So maybe it's can I afford to hire somebody? You add that in and you can see here, it's like, well, based on everything got outlined, no, you can't. Okay, well, how much do you need to increase revenue in order to hire somebody? And so what you can do is you can create another scenario. You can either start from scratch, which is going to create a duplicate of the base case, or what I would do in this case is I would say duplicate this, which means you're going to start with that hire. And then what you can do is add in revenue. So this is where you can start to play a little bit and to change up the different scenarios that you present to the client. So you'd go over here. I won't go through that process because I know that we're starting to run low on time and I do see that there's some questions there. But you could add in some more rules and add in another revenue rule to say, what if revenue, we've got additional revenue of $3 grand a month, and that's an obvious that you need $3 grand, but maybe it's that you only need $2 grand more, or you need sorry, I used $3,000 every 2 weeks. So let's say, maybe you need $4,000 more a month in order to make it work, whatever that looks like for break even now, or that they're not going to dip to the negative. So you can really start to play around with these. You can have as many scenarios as you want. I mean, honestly, I've only probably seen about 5 or 6 built out, but you can keep creating these, and then you can also take them off if you don't want to muddy your base case, so that if you're wanting to show the client without showing those cases, those scenarios, you can do that. They're still sitting here hanging out. They're just kind of sitting in the background for you to click on them again if you want to use them again. I think only other things that I wanted to share about Helm would be, let's see, you can, when you go here, you'll see all of the companies that you've got. So if you've got numerous clients on here, it's really quick to flip in and out. You can add clients or team members as either full access or view only access. So depending on your client as to whether or not you want them to have full access, depending on your team member, if you want them to have full access. I'm very protective of my base cases with clients because obviously I've spent some time making sure that that is going to be as precise as possible. But you do have that opportunity to add in more users if you'd like to. So I think I'll flip back over to, assuming you guys can still see this, I believe that next we have another, there we go, sorry, another poll question. Yes. So Leon, if you don't mind flipping that up,
sure.
Then we'll have some time for Q&A.
I'm having issues with my second screen.
Oh, I'm glad I'm not the only one today. It is Monday, right?
Oh my goodness. Okay, there it is. It is working now. So poll number 2, I'm going to launch that to get it going for everyone. And then, so the question is, what else do you feel you need to know about cash flow forecasting in order to provide it as a service to your clients? So we have a few answers here: more educational content, the right tool, a cash flow certification, one-on-one assistance, or nothing required, I'm already doing it. So give everyone a chance to get their answers in on that one. Just a reminder, in order for me to be able to send out a CE credit for this webinar, I need you to have answered both of the poll questions, so the previous one and this one. So I'm going to give everyone about 5 more seconds to answer that. So 5, 4, 3, 2, 1. All right, I'll end that and share those results. So there you go, Twyla.
Awesome. Thanks, Leanne. I will admit I was being a bit selfish with this because we are trying to roll out some more educational content and really, like I said, share about our experience. This isn't the only way to do cash flow forecasting. I will never say that it is, but it's something that's important for us to make sure that we're spending our efforts somewhere where people are looking to get more information. So this is really helpful. So thanks everyone for answering that. Okay, so now let's do some questions. I know that I saw a few things. I didn't see the questions, but I see that the Q&A has kind of got some.
Yep, there's a couple there, and I know like Dominique made some comments and has some questions in there. So
okay.
The one I have here is Helm's cash flow forecast based on direct or indirect method? That might have been way earlier.
Yeah, no worries. I can touch on that again. It's
okay.
definitely direct, and it's very granular. It's very, as you can see, it was day by day. I mean, it can go out further that it's not as granular, but it's designed to be granular and very direct for it. Definitely the direct method. Yeah.
Okay, perfect.
I can't see the question, so.
Yeah, no, and she was making a few comments earlier.
Okay.
But I can see she kind of answered herself. So I'm just trying to find the relevant questions here, Dominique.
Yeah, no problem.
No. See, I think you kind of answered them as you went, because she was like, I don't understand. And she says, I understand. So Dominique, if I do miss anything, let me know. But I'm just trying to skip to the questions that you've got. She did make a comment. She likes, you can see the AP by vendor and expense by account code. And then she asks, can we separate AR by line of business income if we have separated 8,000 in sub accounts by line of business, i.e. bookkeeping, personal tax, corporate tax? So I don't know what she means by 8,000, but I think what she is basically asking is if she has her, say, personal tax versus her bookkeeping income separated, can you separate the AR in Helm that way?
The AR listing, the AR listing itself is basically designed to just be what you have and sorted by customer. That said, though, if your AR is only so far. Your AR is what's already happened, what you've already booked for revenue. When you're going to forecast out future revenue, which will be future cash coming into your account, then yes, you can definitely split it out by different. It's going to be then split by whatever GL accounts you have. So if you have a GL account for bookkeeping revenue versus a GL account for personal tax returns and corporate tax returns, etc., you can split that because it will be split by GL account automatically in Helm.
Perfect.
Hopefully that answers the question, but if not, feel free to.
All right. And then, and are all the numbers before tax? And if not, how do they add tax liabilities in corporate tax and GST, HST?
Yeah, so great question. So depending on how you set it up, you can have it that it's including tax or not including tax. So GST, I should say, and HST, PST. You can either, like what I like to do is say, incoming and outgoing is still what, when you get money from a client, let's say that the bill is $1,000 plus GST. So you're obviously going to collect $1,050. And what you're wanting to do in your cash flow forecast is plan for $1,050. That's what's going to land in your bank account. And when you create even a cash flow forecast in Excel, the way that I always explain that is you're trying to create your bank statement for the next 3 months or 6 months, however far you're going. So for example, if you've billed $1,000 plus GST, you're going to collect $1,050. Now down the road, you're going to have potentially GST owing or a GST refund, depending on your industry and what's going on with the business. And so what I do is I forecast out. So for example, if your client's on quarterly GST, you're going to estimate out what you think that quarterly GST payment is going to be. And one of the forecasting items was GST payable. So I always use that as a dictator of how much will I expect to pay. Like I set that up when I do my initial setup. I say, okay, they're quarterly. The next payment is due January 31 for the end of December. And so I'm going to anticipate that that's $5,000 because historically that's what it's been. Now I can sometimes when they're on quarterly GST, I'll find myself adjusting it depending on how their quarter is going. But I do set that up, and I'm always with everything. I'm super conservative. I'm not conservative to the point they're going to run out of cash and not do very well, but conservative to the point of like, if historically they've been $5,000, and even if I think maybe they're going to have a lighter one, I'll probably still put it in as 5,000 rather than saying, I'm going to estimate it 3 and it's, oh shoot, it's 4. And that makes a difference as to whether or not they can pay payroll. So you always want your ins and outs to be gross, and then you count for your GST, whether that's corporate tax installments, GST, PST, whatever, on the date that it's due. Think of it as if you're creating in a direct forecast, you're creating what are all the ins and outs that are going to go in and out of that bank account over that time frame that you're forecasting.
Awesome. Thank you. Okay, so Dominique had a couple of comments here throughout. 12-month average is really nice, she says, especially for regular items. And she really liked the test scenarios, especially for the expenses. Now I have another question. So Dominique has said she would like to understand cash flow requirements by industry or customer types or size. She would also like to understand cash flow direct method versus indirect method, why, when, and what difference does it make to the cash flow forecast?
Yeah, so that's going to probably be a longer conversation than what we have, but I'm happy to jump on a call with her. And at the end of this, you're going to get all my contact information. But you know, a direct method is like I said, that's basically what we're outlining. Indirect, depending on how you're doing it, can even involve like a three-way forecast. So what you should do and when is very much, again, what's your client's needs, what industry, what how tight are they on cash? I mean, for a lot of clients, you know, you can, if you do indirect and don't go as granular, or even do a three-way sometimes, but let's call it indirect, you can even go so high level that from month over month, it looks like it's fine, but in the middle of the month, they dip to below zero if the timing's not right, because there's actually a gap. So maybe from the end of the previous month to the end of the next month, it's fine, but you're missing out on what's happening throughout that month. Again, keeping in mind, if you're trying to create it like as if it's a bank statement, line by line, what's happening each day, considering that running total. So definitely there's certain industries where indirect makes more sense. There's certain industries where three-way definitely makes more sense. You know, ours can do three-way, but it is manual in terms of what's pulling in from the balance sheet. That is a bit intentional in that if you pull in too much for the bank balance sheet, if you're using a lot of accruals, that's going to get really messy versus saying what's on the balance sheet that is actually cash. So GST payments, dividends, loan payments, you know, there's this kind of handful of things that come to mind that a basic client would have, not more complex, a basic client would have that would be actual cash versus things like prepaid expenses or unearned revenue or deferred revenue or insurance that you've, you know, amortized or put out as a prepaid over the course of 12 months. So it is as in I said with any great question, the answer is it depends, but I'm happy to walk through that with anybody who has some questions around, you know, okay, here's the industry, here's the type of client, which type of forecast do you recommend? Happy to have that dialogue with anybody.
Perfect. I'll let people reach out to you on, you know, more details for things like that. I got a bunch more questions. I'm going to try to get through as many as we can, guys. So Gilbert has asked, how accurate is the cash flow forecast if the historical data is not up to date, i.e. 30, 60 days and beyond behind?
Yeah, this is a great question. I mean, I always encourage people to do the cash flow forecast with their workflow. So if your workflow is that you catch everything up monthly, that's the timing to do your cash flow forecast, not when your cash flow forecast is 29 days, or when your reconciling is 29 days since you've last touched it, and or longer. So I've seen cash flow forecasts that have been done. They're still quite accurate, even though reconciling within QBO has been a few months behind. Now, the further that goes, the less concise it will get, because you've got things that have rolled through that you're now on your cash flow forecast to say, did that happen? Yes or no. We pull in the QBO balance, not the bank balance, and that's intentional too, because if you've got things sitting as unreconciled, then they're going to be still showing up in your cash flow forecast. So it's a matter of kind of making sure that you don't double count or you don't exclude something when you haven't got right up to date books. It can be done, but I would definitely say the longer it's been, the less precise and the less accurate you'll get.
Awesome. Tiffany asks, are the opening cash balances pulled from the GL or cleared transactions, which is
which is where I was just going. Yeah, so it's QBO. So that in the event that you've got something that isn't reconciled yet, it's essentially then still going to be sitting in your cash flow forecast. If you use the bank balance, you're going to miss anything that has cleared your bank, but you hasn't cleared QBO, and then you'll have a gap. So that has been set up intentionally to try to avoid that gap.
Okay, awesome. Gilbert asked again, does Helm plug into QBO and Xero only, or can it plug into other accounting softwares?
QBO and Xero are the only two accounting softwares that it plugs into now, or it pulls from now. There are some other integrations on the roadmap. I can't really kind of go any further than that, but we just launched our QBO integration a couple of weeks ago, and we've got a few other things kind of in the works before we'll probably look to any other integrations just yet.
All right, perfect. And then Wanda has asked, can you talk about how you use this with clients? Do you allow them into the system or do you sit with them and go over and play with the scenarios?
Great question. So first time I go through it with them, I definitely get on a call or sit with them to go through it, because then I want to talk about things like scenarios. Then ongoing, depending on the client, either they have view only access, or I actually do like a shot of those graphs to say, like, here you go, you can see we've done it, we've looked at it, we've best practices, we've reviewed your cash flow and you're looking fine. Or on the flip side, something needs to be done. That's always a reason to jump on a call. So it just kind of depends on your client and how tight their cash is, how, what have you sold as a service? How frequently are you able to go into this and have dialogue with them about it? But initially, I definitely walk through it to give them a feel for, like, what can we scenario, because that can even start some conversations that they didn't think you could have in the past.
Okay. I'll try to get through one more, and then I don't know, do you have any extra time, Twyla?
I'm okay for time.
Okay, so we'll try to get through one or two more.
Sure.
So I have a question here. It says, I need a forecasting report to submit for financial purposes that has zero revenue for applying for construction/developer draws. Can this be used for that purpose?
So if I'm understanding correctly, you want to have all the expenses, but no revenue. Is that fair?
That's, I understand it to say that, yes.
Okay. So what I would do in that case is I would toggle off the revenue accounts, and I wouldn't delete them, because obviously at some point you might want to actually forecast out what will really happen, but you could just toggle them off. You could toggle off all of your AR, you could toggle off all your revenue accounts, and basically you're going to see all these negative. It's not going to look very good probably unless they got a huge bank balance. But that would just display then any expenses, and then if you added in any things like GST or loan payments, etc.
Perfect. Okay. Tiffany asks, can formulas be used for expense predictors, i.e. 52% of sales to be projected as cost of goods sold for a retail business?
Yeah, great question. That's one of the things that's on that roadmap that I said that when we've got a few things in the works before we do any other integrations. And that's one of them, is a calculator tool where you can either have it say go a percentage higher, percentage lower, or a percentage of a different account. So that is coming because I think that's a really useful tool. Right now it's not there, but it's definitely on the short-term roadmap.
Okay, perfect. And unless somebody else pops in, I'm going to send this out as the last question. So from Dominique, does Helm support Excel or CSV import or export?
Yeah, we get this question every once in a while to see if it imports. It does not. Helm has to be used with an integration of some sort at this point. It's something that we're discussing being on the roadmap. So if that's something that, a variety of you are saying, I want to be able to do that, let us know, because we've had the odd person to request that, but it isn't something that it does right now.
All right. Mm-hmm. Okay. So I think we managed to capture most of it. I'm sorry if I missed anything, guys. There was a lot happening there for a little while. And I tried to reply back. There were a few chat things happening too with poll questions. So anyways, that's all I've got. So Twyla, you've got some contact information there for everyone.
Yeah, so obviously I've got our website, and I think this is going to be coming out in the email after this webinar as well. We do have a Helm, we call it the Helm community, which is basically just a Facebook group where people can share about not just cash flow, but advisory as well. So that's available to you. And then of course my direct email address. So if you want to reach out to me, feel free to do that. I'm happy to answer any questions that anybody has. From that, if you're wanting to book any sort of onboarding or more of a demo, or want to walk through some specifics with a client scenario that you've got, let me know. And then there's also the opportunity, if you go to the website and you just want to kick off your free 15-day trial and you just want to get started and say, leave me alone, I don't want any help until I hear from you, or until you hear from me, then you can do that as well. And you can do that right at the website.
Awesome. Well, that's amazing. Thank you so much for joining us here today. I really, really appreciate it.
No problem. Oops, and I clicked on the link there. There's the Helm community. Now you get to see what I'm talking about. So Yeah. Okay. Perfect. Yeah. I appreciate the time, and I'm so glad that everybody joined us on a Monday, and I hope everyone has a great week. Any questions, feel free to reach out to me.
Awesome. Thanks again, Twyla.
Thanks. Bye.
Bye, everyone.